All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I'm going to pause here just for a moment, verify that we have audio. I did do a stream here that ended just about 5 minutes ago, but looks like the recording doesn't have audio, and I'm being told by Michelle that some of you did not have audio for it, and my apologies for that. I did have the thumbs up in the test accounts that the audio was streaming, so I'm not exactly sure what happened, but do want to make sure that audio is running here. And then we'll get stuck into it. We're good. Awesome. All right, let's start here with an analogy, because I want to talk about trader psychology in the context of bottoming and how the market's acting and what it's doing. And so take yourself back to grade school. You're a kid, you're coming home from school, hungry. There's a cookie jar on the counter. You go grab a cookie. You enjoy that cookie, and you move on. Next day, you come home from school again, grab a cookie, yum. You get into this routine of grabbing a cookie, yum. Then your mom comes to you and says, hey, hold on. No more after school cookies. I don't want you ruining your dinner. You can have a cookie after dinner. And you think to yourself, I'll show her. But you say, fine, Mom. Okay. But the next day you come home from school, and what do? You see that cookie jar. You go, you grab a cookie. You scurry off to your room. You enjoy that cookie. I mean, I never did that. Yeah. But you enjoy that cookie. Next day, come home from school. You don't hear anything that about the cookie and having snudged a cookie the day prior. So what do? You grab another cookie. You enjoy that cookie, and it's great. And you get in this habit, this routine of coming home from school, grabbing a cookie, and it's wonderful. And hey, the cookie jar keeps getting refilled, so nobody has said anything to you again. And so you think, hey, this is great. Life's good. Life is good. Then you go off to school the next day. You come on home. There's that cookie jar. You grab yourself a cookie. You think, hey, boom, golden. You scurry off to your room, and you take a big bite of that cookie, and immediately you spit it all out. Somebody decided to replace the sugar in the cookie with salt. You think to yourself, wow, that's nasty. You spit it out, you get a drink of water, you try to clean your mouth out. That was just a really bad taste. And you think to yourself, well, do I go ask my mom what's wrong? If I do, I'm admitting that I've been taking cookies. So you think, nah, you just get rid of the cookie and just, okay, you move on. Next day, you go to school, come on home. There's that cookie jar again. Man, you've had a great experience with cookies. So you go and you steal another cookie. Scurry off down to your room. This time you don't just, shove it all in your mouth. What do? You take a couple nibbles. You're trying to test, hey, is this cookie good or not? You take a few nibbles. Ugh, man, nasty again. Ugh. So you throw the cookie away. Next day you come home from school. This time you see that cookie jar. You're like, do I really want to? You say, I'll give it another shot. And you go out, you grab a cookie, get down to your room, give it a couple licks real quick. You can tell, no, this cookie's not going to be good. You get rid of the cookie. Next day you come home from school. Do you even think about the cookie jar? Do you really want a cookie? Nope. Your mom very quickly has taught a lesson of, hey, wait till after dinner to have a cookie without having to say anything. Think about dip buyers in the market. When we have periods like this in the market, it reteaches, it retrains investor and trader psychology. And investor and trader psychology here of late for the last several years has been buy any dip, buy it aggressively, because, man, the dips are great. The dips are fantastic. The dips pay. And so investors, they go out, they buy the dips, they get involved in the dips, they get that positive reinforcement like they do from a really good cookie. But what has happened this week? They've grabbed a cookie and it's been loaded with salt. They grabbed a cookie again, loaded with salt. What are investors going to do? And it looks like Thinkorswim is frozen here on me. Ah, there it comes back. But what are investors going to do? They're going to change their behavior. Look at this rally yesterday. This rally yesterday took the market on S&P from about 3,000 up to almost 3,100. It was almost a 100-point rally in the S&P. Monster rally that was erased hours later and then some. What's happening to the dip buyers? They're getting burned. They're getting burned hard. They're getting burned fast. And they're getting retrained. Are they going to be as eager to dip their hand in and buy a dip? No. It's not paying off. So they're going to slow down. They're going to stop even thinking about buying dips. And that's what we have happening right here. And when we see a market that goes into free fall, we have to understand that it's a psychological switch. And there's a shift in that psychology that is going on that's very similar to a kid coming home from school and getting a cookie. Eventually, mom is going to put good cookies back into the cookie jar. You're going to come home from school. You're going to see that cookie jar, and you're going to, you know what, I'll try it again here. Some time has passed. I'll try it again. You'll take a small nibble. Man, that small nibble was really good. And so you'll finish the cookie. But the next day you'll come home from school, and are you just going to go grab a cookie and shove it in your mouth? No. Your behavior is still retrained. You're going to grab a cookie, and you're going to still nibble. Take a small piece. You're going to test the waters. That's what dip buyers are going to start to do. They're going to start to nibble. They're going to start to test the waters. They're going to dip their toe in, not just jump straight in. There is a shift of psychology that has been thrown at investors this week that when we see it happen, typically takes weeks, if not months, for it to get back to where the cookies are great. Does it matter the metrics on the cookie? Does it matter the size of the cookie? Does it matter if the cookie is, what flavor it is? Does it matter, what the PE ratio is and what the sales are and what the support and resistance levels are? Nope, doesn't. None of that matters. It's the salt in the cookie. It's panic in the market. And right now we are dealing with a market that is in absolute panic mode in a way that's almost historic. As we go forward, as we see bottoming signs come into the market, I'll jump on, I'll show them, I'll talk about them. But so far we haven't seen hardly any. This is a market of pure panic. And you know why you can say it's a market of pure panic? Well, it has nothing to do with the magnitude of move down. The magnitude of move down is sharp, right? We have a staircase up and a elevator down. That old kind of market saying. But how do we know it's panic? Because there's no safety. Take a look at gold. Gold's selling off hard. There's no safety in gold. Utilities. That's where investors rotate into, right? Nope. Utilities getting hit hard. Well, consumer staple stocks, they're recession-proof because people always need, toilet paper and mouthwash and toothbrushes, right? So buy staples. Oh, man. Consumer staples getting shellacked. There's no safety there. Real estate. When stocks go crazy, real estate stabilizes. Oh, real estate? That's getting hammered. There is no safety out there. Absolute none. None in terms of safety. And that's how you know this is a market that is in full-on panic mode. And full-on panic mode ultimately creates opportunity when full-on panic mode starts to subside. But predicting when full-on panic mode is going to end is a very difficult endeavor. A very difficult one. And so far, we don't see a lot of signs. What's the best sign that we see? The best sign that we see is the VIX. Take a look at the VIX. The VIX has gone from 16 up to almost 50 today. Almost 50. That is an absolute monster move here for the VIX. What's it compared to? Well, here's the VIX over the last year. This is the highest level we've seen in well over a year. In August and May, the VIX only went up to the 20s. Now we have a VIX that's double. Well, how does that compare historically? Well, let's go back more years. Let's go back 10 years. Have we seen the VIX up at these levels? Yeah, we saw it hit up at this level back in 2018, in February of 2018. We saw it happen in July or August of 2015. This is when we saw the panic selling with China selling some of the assets. When we saw the Ebola virus, it only came up to the 30s. The Euro crisis with Greece and everything, it came up in July up here to the 50s. And the flash crash, well, we're at flash crash levels. That's where we're at. We're in that fear level of what was seen in the flash crash, which is pretty amazing. Now, what happened in the flash crash? Yeah, the VIX started to come down, but markets still went lower. Yeah, they popped a little bit, and the volatility came on down, but markets still dropped. So it's not like you could say, well, the VIX is high, so markets are just bottomed and they're just going to go up. But we are dealing with a historically high VIX, and this is one of the arguments that I think is one of the best for saying, hey, we're overcooked, we're overdone, some rationality is going to start to return back into the market. Can you play it? Can you play the VIX? Well, let me show you the options. Here's the VIX. Here are the options. And if you want to play that the VIX is going to drop and to go down, you can buy the 50 puts. They're going for $21. They're going for $21. What does that mean? That means that if you go out and buy these puts, you need the VIX to go down to 29 in 18 days in order to break even. So you need the VIX to come all the way down to 29, which is right here. Let me mark it for you. To break even. You know what you need for a double? You need to go down another $21. You need it to go down to 8, which is all the way down here. Worth it? Worth the risk for, what is relatively little reward? No, not at all. Well, market makers aren't dummies. They know that the VIX can come on down very fast. They're not going to give it to you on the cheap. You say, well, what about going out and buying a put on something like the VXX, which is a derivative of the VIX? I mean, the VXX is chunked up to 25. Well, take a look at that pricing. That pricing is pretty insane as well. I mean, they want they want more than 10% for an at-the-money put. Implied volatility on the VXX options is 127. It's insane. It's super heavy. So it's not like you can jump in and say, well, I can get an option on the real cheap here to, go and play for a VIX drop. It's just not the way the market is priced right now. And that's very normal. That's very normal. But the VIX action or the VIX level is perhaps the best argument for the bulls that, okay, things have gotten out of control and mom's going to stop putting salty cookies in the cookie jar. But that's about the only sign that we see. What's driving the market panic? Well, it's the coronavirus. I showed this chart a couple weeks ago. This is from Johns Hopkins, and it tracks the outbreaks and cases of the coronavirus along with the deaths and recoveries. Take a look at the deaths and take a look at the recoveries. If most people that have come down with the coronavirus have recovered, not died. But why is the market panicked? Well, because what was concentrated here in China in terms of cases is now spread across the globe. 60 cases in the U.S., Europe. Take a look at all these cases that are coming up. We're starting to see them, get into Africa, in Australia. Middle East has started to get some cases. We've got our first case up there in Russia. So it's one where we're starting to see cases increase globally, meaning not necessarily the number is getting out of control, but the areas affected, the areas that have to be contained, are becoming almost infinite to where there's talk of, hey, it can't be contained. But the reality is we see the recovered numbers improving and improving in a pretty strong way. So there's a long way to go. But this is not exactly the type of thing that is going to wipe out half of the human population. So what do we know? We know this is a fear driver. Valid, good reason, yes, all of that. But what do we also know when the markets react to fear? We know that the metrics don't matter. Earnings don't matter. Revenues don't matter. Price-to-book ratios don't matter. PE ratios don't matter. Support levels don't matter. I talked about the 200-day moving average yesterday when it came to the S&P. It basically said, who cares? It doesn't matter. It's not relevant. Right now, those metrics simply are not relevant the way that they tend to be in more normalized, more or less panic-driven markets. But right now, it's about panic. Right now, it's about fear. And ultimately, that will change. But fear, panic, has always been a part of the markets. It always will be. And it is a piece that ultimately creates a lot of opportunity for investors. For option traders, doesn't create a lot of real-time opportunity unless you're day trading, because option prices are just absolutely insane. And so you need a monster rally or a monster drop to justify them, and you get both, right? You get both, but they're all they tend to be in a little bit of a shorter term there. All right, as we get more signs from the market that bottom is in, or maybe a bottoming process or something, I'll talk about it. I'll get on, show it. As we see that happen, I'll get on and I'll talk about some of the fundamentals of stocks, where, some of the mispricing that has happened, because we are seeing mispricing start to happen. Chipotle Mexican Grill, one that, absolute mispricing going on right here. Great. I said that yesterday. Doesn't mean I can go and buy it, because we can get, mispriced in a much, deeper, much greater way, and I have to be wary of that. But as we see things stabilize, normalize, those things will come back and they will matter. But for now, they simply don't. They simply don't when the market is dominated by fear. For the challenge, there are no new signals on the board here, as you probably can guess. As far as downside crossovers, we have GLD, but coming off a new high, not going to create a bearish trigger. And on the upside crossover list, there's absolutely nothing. And it is something that, not very surprising. We talked about it earlier this week, that would probably be the path. So right now, probably the trade that's closest to setting up is some sort of bullish reversal on the market, where the market vibe turns bullish. That's not going to happen today, most likely. But if we see that happen, I will go after that with the with the challenge account. And then as we start to get crossovers start to come in, we'll assess them and trade the ones that are signals and go from there. But I will be patient in the meantime. And that is something where I'm not going to look to go force anything or try to readjust or readapt. No, I'm going to be patient. Let the panic and high option pricing pass, and use the mispricings to react to the next signals in the market and go. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you later. Take care.